Okay, recording is on. Today is Tuesday, July 16th. Basically, we are in week 2 of our classes. And as we get started today, I want to talk about our EIC assignment that we just completed before we get into some new content. But before we do, just questions, comments about anything. Miscellaneous? Something we want to ask or talk about?
I guess I had a cool question.
Sure.
I was wondering like what your opinions were on like today Trump came out and said to Bloomberg that he's going to cut corporate tax rate to 15%. And then obviously the Dow had like an amazing day today. I was wondering like what you think what the market's going to evaluate it with the corporate tax rate being cut to 15%. And how that is going to change kind of analysts, opinions about certain equities.
Well, we'll take it at face value because there are some consequences to going to 15% to our deficit, which will have an impact on this. But let's assume that we put that aside. One of the things you'll learn in the fourth section of our class on multiples is that as tax rates go down, prices go up. So values of stocks are worth more at lower tax rates. So the relevant issue is not just whether or not that tax cut happens, but whether or not the tax cut that was made previously to move the corporate tax rate expires, which sends corporate tax rates back to 28%. So that's also relevant here, because whether or not those tax cuts are renewed will also affect stock prices as well. But good question, good point. Other general questions? I mean, I think the other thing that's going on with the market, in case you're coming with any other questions, is what happens with interest rates. Because as you know from key value drivers, if interest rates start to go lower, cost of capitals go lower, and therefore prices go higher. So that's the other thing that's driving the market. And I think there were some comments made by our Fed Reserve Chair who said something to the effect this past week of we don't necessarily have to see inflation at 2% to actually start lowering rates. And I thought that was a signal to the marketplace that rates might actually start coming down. And I think that could also be another reason why you see a short-term rally in share prices. Spencer?
Yeah, just because we just did it. Nvidia has not seen the gains of the last 2 days that everybody else has. Are people finally done with Nvidia, or did the Goldman Sachs article really crush them that much?
What was the Goldman Sachs article?
It basically said the Gen AI is overhyped.
Okay.
It basically said that's really probably oversimplification, but it said that they have not found a way to make a profit with Gen AI. So if they can't make a profit with Gen AI, eventually the spending has to stop.
So I'll answer it slightly differently. Can you see my screen on Bloomberg?
Yep.
Okay. So if we talk about Nvidia, okay, and we look at the consensus estimates for Nvidia again, just focus on two numbers, row 13 and row, call it EBITDA, row 17. So that share price is generally reflective of hitting those numbers. And they're aggressive. I mean, as good as this is, you're talking about Nvidia more than tripling its revenue by 2028, and Nvidia more than essentially same thing, tripling its EBITDA by 2028. Okay. And that's aggressive for any company. Because you're talking about basically an EBITDA margin that's now approaching 60%, rough math, 137 divided by 211. And so, that's high, even in the semiconductor industry. So all I'm saying is, the chances of them not meeting those numbers is increasing as opposed to exceeding those numbers. And I think that's the challenge with Nvidia is that, the upside is everybody's figured it out. It's already extraordinarily aggressive, and they have to keep beating that upside in order to keep driving their share price higher. And I think whether Goldman said this exactly, reasonable question is, it seems like there's more downside risk than upside in these numbers. So if they don't get to these numbers, their share price will be lower. And I think that's where I think people are starting to look at reframing the conversation around Nvidia. I'm not saying it can't happen, but I think that's what we're going to get into when we get into valuation. And by the way, SPLC, their revenue, companies on the right, is their supply chain. 20% of their revenue comes from Microsoft, 10% of their revenue comes from Meta, 7% Alphabet, 6% Amazon. So that is 40, call that, I don't know, 42% of their revenue are those four companies. And that's where most of the AI is being spent. And so if they cut back, or if they shift, then that will also start to impact Nvidia. Any other questions, comments, general, before we get into EIC?
On the left there, you have Taiwanese semiconductor company, and it says cost of goods is 36%, which I'm assuming is Nvidia's cost of goods. 36% is coming from TSM, correct?
In terms of, so yes. So Nvidia represents 35% of the cost of goods of Taiwan Semiconductor and 10% of their revenue.
Got it. Okay.
Whereas on the right, for Microsoft, Nvidia, 19% of Nvidia sales are to Microsoft. That represents 45% of Microsoft's capital expenditures right now. So think about that. All that data center money they're spending, 45% of it's going to Nvidia.
This might be a dumb question, but how do the analysts, or I guess Bloomberg in general, how do they know which companies are spending what amount of money at other companies?
Some of it is coming in public filings, other it is just Bloomberg research. So, because you'll see here proprietary.
Got it.
Public filings and research, do they have to cite their sources?
No. But you got to pay for them. You got to pay for all that stuff.
Yeah.
But they're usually fairly good about it. For most of the data in here in Bloomberg, they'll show you the source it came from. But when it says proprietary, it's proprietary. All right. This is a good lead in, I think, to our EIC assignment on the semiconductor market and Nvidia. So relative to your first question about economic sensitivity, you would have started with, and I'll just stay in Bloomberg rather than going to the image because I don't think it's changed all that much. But you'd have gone to the beta and had a screen that looks something like this. And so what would you have said about economic sensitivity. Is the semiconductor industry economically sensitive?
Yes.
Yes.
Yes,
And why?
because the beta is 1.7.
Okay. And what about Nvidia relative to the industry?
They have the highest beta throughout the entire industry by, what's it, 0.09 compared to Marvel, I think was the one, which was interesting because Marvel also had the ROIC, which was the lowest out of the entire industry.
Okay. But the other point about the 1.9 is it's even higher than the beta of the industry. So they're probably even more sensitive. And I guess the other question is why? Like what is driving this economic sensitivity in semiconductors? Why is this such a cyclical industry?
Because we're at the foreground of AI, so everyone's trying to jump on top of it.
Okay. But what's driving cyclicality? Because that's the whole idea. There's volatility here if you got a high beta, because it goes up and down by 1.7% every
Is
time.
it just for the other like firms and places that are looking into the technology need to have the excess money and ability to like do all of the R&D, so when the economy is good, they potentially have that going, but if it's bad, those are the budgets and things that may get slashed.
So is Sarah on this call going to go out and buy Nvidia chips?
No, but
You can buy a Blackwell chip for $30,000.
no, but wouldn't she potentially buy the technologies that those chips help power? So would there be like, I don't know if it's upstream or downstream effects from a poor economy there?
Well, I'm getting to who are these companies primarily selling to that are on this list that we're looking at?
Governments.
Yeah, this is a B2B market
Mhm.
more so than a B2C market right now. That's what's driving this. And the B2B market is somewhat cyclical. Like, because that's the point. Like if the economy takes a hit, then businesses are going to invest less. If businesses invest less, they don't buy as many chips. And then the sales will not go up as much. So I think that's essentially, both the benefit to the boom of the AI, but that's a risk to AI. Because right now, I just go back to a vast majority of the spending on AI is for companies. And they're the ones that are driving a lot of this boom. And if they start cutting back because they're not getting, the demand for their products, then that would have a big impact on Nvidia and to some degree semiconductors in general. So it is very much a B2B driven business. And that makes it a little bit more cyclical. Okay. But at a minimum in your assignment, you should have at least identified with the high betas, the 1.7-ish, depending on, I don't remember what's in the screenshot, this is 1.74 and about 1.9, that it's a very cyclical industry and very volatile. And the other part is Nvidia even more so right now than the market, and at least some rationale for why that's going on. That was probably the easiest of the EIC questions. All right, let's move on to industry. Was this an attractive industry? Or is this an attractive industry?
Yes.
Okay, so spread is at the industry level. And again, this is today, I don't know if the reporting has changed this, but about a 58% ROIC versus about a 12.5% WACC. So that's about as good as you're going to see it at an industry level. So yes, this is an attractive value creating industry. So why? 5 forces today. What in the 5 forces explains this extreme spread? What'd you guys say?
Said high barriers to entry. So you had pretty advanced technology that's expensive to develop, and then there's also patent protection on it. And then with that, there's additional funds needed to train the models that your generic startup isn't going to be able to put into the company.
Yeah, because these things are built on fabs, which cost tens of billions of dollars. So really high barriers to entry for the reasons you just mentioned, beyond the IP, as well as the cost, that tends to favor the semiconductor industry, keeps the smaller players out. What else?
Not a lot of substitutes.
Mhm. What would a substitute be to this industry?
A CPU.
Or quantum computing.
So potentially quantum computing could disrupt semiconductors. Now, I don't think it's quite here yet, but I think that's a potential 5-year one, at least, that we could be talking about. But I guess, are there real viable substitutes to semiconductors today? That are threatening them? Today, not as much. And I think that's helping the industry spread.
They're making chips. They're trying to make chips using photons rather than electrons to transmit the signal. So
Would you call that a substitute?
well, it doesn't use silicon. It doesn't use semiconductors.
Does it use semiconductors?
I mean, it's probably these companies that would do it, but
Okay. And photon-based computing, sorry, my ignorance here, that's not the same as quantum computing?
no.
Okay.
Basically, with these semiconductors, it's they're passing electrons to flip bits.
Yeah.
And they're trying to figure out how to use photons to flip bits because light consumes less energy.
Yeah.
than
And
photons.
I'm assuming it's faster. Yeah.
Yeah, right, and faster. It's really hard to control light that way.
Yeah. But today, I don't think that that's sort of in that viable substitute that's really threatening the industry category today.
No, it's probably like quantum.
Yeah. A couple
It's
years
out there.
All right. So substitutes are favorable. Barriers to entries are favorable. What about the other 5 forces today?
I said the buyer power was kind of moderate or in a global economy, especially low, because it was limited by only a certain number of these companies can build these chips and at the level they want. Like even some of these small companies may exist, they can't build to the production levels that some of these bigger Magnificent Seven companies want.
Okay. So supply and demand is going to be kind of big. And right now there's a lot of demand. and really, there is a little bit of a historical boom and bust cycle, meaning sometimes this industry has too much supply and that tends to hurt the profitability of the semiconductor industry. And right now there's excess demand and that's really been helping them. And that was kind of triggered particularly by COVID, because one of the side effects of COVID was that as we started to do remote work, et cetera, was more electronic devices, right? And that has been a boom. And now the data center boom is continuing that boom. But nonetheless, all that demand probably hurts the buyer power in a way, because, if you can't get a chip, then you're going to probably pay a premium for it. If you can even get the contract. And some of the chips, again, are proprietary in Nvidia's case. And so I think that has been benefiting the industry as a whole. So not a lot of buyer power right now. What about suppliers?
I think suppliers have a lot of power.
Okay, why do you think they have power?
Because they.
Um,
No, go ahead.
Go ahead.
Yeah, I
Oh,
know there's TSMC that supplies to Nvidia, and there's not really a lot of options other than TSMC for Nvidia to get some of its products that it needs in its supply chain.
So for the contract manufacturing, the TSMCs of the world, they seem to have a lot of power, but are they exercising it in a way that's hurting this industry? Alex?
I would say no, right? Because it's like a symbiotic relationship where, yeah, they're the only suppliers, but they have a very small subset of buyers too. So if they exercise too much power, it could actually end up hurting themselves instead of helping.
Yeah. So part of the analysis we're trying to do is, does somebody have power? But then the other key is, are they using their power? buyers might have a lot of power, but if they're not using the power, then that power is not really hurting the industry. So in the case of, I think you're right, maybe some of these suppliers are accumulating a lot of power, but currently they don't seem to be using and exploiting that power to the detriment of these firms. It's been almost more win-win in their relationship than win-lose. And so I don't think it's hurting the profitability of the industry, but maybe that's a little bit more less favorable to this industry, but probably still favorable in a way that they're not exercising their power. So 4 of the first 5 forces, 3 of them are very favorable. 1 is a little less favorable. What about the rivalry? Is there a lot of rivalry here?
I don't think so, because there's only so many players that can create these chips at the same scale.
So this is more like an oligopoly than kind of like free-for-all competition.
It's like a winner take all, because whoever designs the best chip captures the market. And for Nvidia's competitors like Intel or AMD, they all have to kind of specialize to carve out their niche. And there's only 1 or 2 folks that can make the most advanced chips. So kind of all your eggs go in one basket.
Well, think about what Apple's been trying to do with Qualcomm. For years, they've been trying to throw Qualcomm out of the iPhone. We'll build our own chip. They've had 0 success. In fact, a few years ago, it was so bad that they ended up writing off their whole business for cell phone modems. And basically, they were partnering with Intel, miserable failure, and they had to crawl back to Qualcomm and basically pay more for the chips than when they started the process because they couldn't find a way to get around Qualcomm's patents. And they still are. Like their goal is to get around the patents and essentially throw Qualcomm out of the iPhone. But I guess that's the point. Like some of these firms have a lot of IP around their technology. And if you want to use it, it's not as easy to just go recreate it. Now, some of the chips are commodity, but I think even in the short term, the commoditization gets back to supply and demand. There's so much demand for digital devices right now that even the commodity players are not being challenged on the supply side and generally not being challenged on price. So the rivalry is another way of saying it. Right now, it's not that high. And so if you think about it from a 5 forces standpoint, like all the forces are pointing to green. Like the rivalry is not that high. The buyers don't have a lot of power. The substitutes are not really threatening to this. The barriers to entry are still extreme. So you don't just see new players coming in to exploit the supply and demand imbalance. And even when suppliers seem to have some power, they don't seem to be exercising it against the industry right now. And so this is just an amazingly attractive industry. Did anybody else say something different than what we just mentioned, Thomas?
Yes, I made kind of a different argument in 2 of the areas.
Sure.
One was on the barriers to entry. If Nvidia was a manufacturer, I think that we could say that the barriers to entry were high, but I made the argument that they're primarily a chip designer. So comparatively, the barriers to entry there are much lower, and that someone would kind of just need to hire top talent, and that would be their highest cost. But that's nothing like building out a fab. And with all the investment that the U.S. government is making to help the manufacturers increase their capacity, they're going to be able to service more competitors to Nvidia over time, compared to if those investments weren't made. And then I thought, what was the other spot that I made it different? Oh, on the supplier power. I think I said generally the suppliers didn't have power, but TSMC's margins compared to the industries, I think the industries were like 7%, but TSMC had like a 40% profit margin, which shows that comparatively they are exercising power.
Yes.
So, and it was really just the buyers in the situation that I didn't think had power. And that was really only like kind of just the deflationary nature of technology that was keeping the prices of chips low for buyers.
Well, first, I like the fact that you're using data as you're supporting that. So that was very important in your answer. But let's just take the premise of what you just said. Is that supplier power hurting this industry's ability to make a return?
No.
And so that's the point. So even if you're saying people like the contract manufacturers like TSMC are having a lot of power, they don't seem to be hurting this industry enough, because maybe the other forces are just overwhelming that. So kind of two views to get to the same answer, but I like the way that you framed it, and that's reasonable. All right, Spencer.
Yeah, I differed on the buyer power because, as you pointed out earlier, it's 40% is made up by 4 companies. Like
Well,
that.
that's just for Nvidia, not all semiconductors.
Yeah,
but-
and I will make a slight distinction between semiconductors here and the GPU threshold. Why this is railing so much is because AMD and Intel don't really compete in the GPU areas, and GPUs haven't really been useful other than for gaming and Bitcoin until recently.
Yep.
Like nobody's had the ability to do it. So eventually these companies, like as soon as they hit their supply caps, like Amazon has already said they're making their own chips, and like GPUs are notoriously much easier than CPUs because you're just doing simple addition rather than multiplication.
But what you're highlighting is the bleed into the next part of the question, which is how is this going to change over 5 years? So you're already inferring what some of the changes are going to start likely being from your perspective to some of these forces.
I agree.
So again, I'm not saying it's right or wrong, but I'm saying that's part of what we want to do. It's like, all right, let's explain today and let's start thinking about tomorrow. Because if tomorrow's different than today, it's going to start affecting things. And you're already talking about how some things are going to reshape our view of what these things are going to be like tomorrow. And so I think that's a good lead into the next 5 years. But before we do, William?
I think Spencer makes a good point about like GPUs not really being useful until recently. But to your point about 5 years from now, everyone's running to catch Moore's law, and the capital investment required to not only design but build the lithography equipment underlying all this is so much that you've only seen like a consolidation in the industry over the last 30 years of players who can actually operate at such a high level. And so once a company is able to capture significant market share and make a bunch of money, they're going to be best poised to invest into the next thing, and they'll win that next race.
So what I'm hearing you, so let's shift to what's going to start to change in 5 years. What you seem to be suggesting is that the spending is going to become a challenge for the industry. So in a way, you could argue that the spending is suppliers. So the suppliers are going to have to be paid a whole lot more money to meet the needs of the growth of the industry, and that to some degree the barriers to entry might be going up in this industry. But it does sound like there could be some demand issues that somebody also mentioned in terms of competition, which drives more rivalry. So maybe people are looking for choices that currently don't exist, and there will be more rivalry for these chips that could cause prices to start to come down.
I mean, I guess, yes. And if anything, I think supplier power increases over time, because when NVIDIA designs a chip, like TSMC has to figure out how to manufacture it.
Yep.
And so they have to work together.
But that's the thing. There's not that many companies out there that do at this scale that level of contract manufacturing. And
yeah,
so,
there's only 2 that can do the most advanced ones. That's Samsung and TSMC.
Yeah. And so that suggests that over time, that balance gets more in favor of those suppliers, which tends to eat into the return of the industry, is what I would infer that you're saying.
Yeah, I guess I didn't reach that conclusion, but yeah, that makes sense.
Well, that's the goal of the 5 years. So the goal of why we're talking about 5 years is eventually to connect to what does that mean to the spread? Because if the forces are getting a little bit more unfavorable, then relatively the spread should move lower. That's
But how is it? My question would be, how is that 5-year mark different than today in terms of like, okay, they're not exerting a significant amount of supply power to hurt the. ability for
It's just been a case that they would, because I heard two parts of the case. Part one is there's only two players, and they're critical to especially the advanced stuff in this industry. And number two, the cost is going up to make this stuff, which means you're gonna have to pay them more and they got to invest more, which means those levels of investments with the suppliers give them more power and then start to also lower the potential returns you're gonna make as an industry. That's what I heard. Did I mishear what people were?
No, Mike, I guess my question is, how is that substantially different from today in terms of the supplier's willingness to exert that power? Because they have an indication of that power today, but they aren't really exerting it.
Well, those are two different scenarios. So scenario one says that they increase their power, but they don't exercise it. Scenario number two is they start exercising it. And those have two slightly different impacts on the industry spread. And so that's a judgment call that you're going to have to make as part of your view of the future. But you at least outline two potential futures that are different than today.
Yeah. Thank you. That clarifies it.
Because that's, again, anytime you're dealing with a future, you're dealing with a little bit of uncertainty. So, which means there's a probability something's going to happen. There's not a certainty something is going to happen. But when we do the probabilities, what does that mean? And what's likely to happen? Well, if you think that it's more likely that they exert more power in the future, all things being equal, spreads will go a little bit lower. Not saying they're going to go negative. It's not going like the automobile industry that I showed you last week, but you could see a little less profitability in this industry.
Yeah, I think I read an article the other day that TSMC, according to Morgan Stanley analysts, is going to be raising the prices by 10% in 2025 at least, for some like the wafers to make some of these chips. So that will like hit Nvidia, AMD, and some of the big customers like that. So they're already starting to exert some of the power at the beginning of next year, is what they're saying. So.
Now, what about rivalry? What do you guys think is going to happen to rivalry over the next 5 years, Spencer?
Sorry, I had a different question before we got into rivalry.
Sure.
I mean, so my question is, do we assume political stability too? Because obviously that's a big issue with TSMC.
Well, given that we just had a presidential candidate try to get assassinated, I'm not so sure we can assume political stability in the near term. But in all seriousness, I think that this global chip race is becoming more of a relevant issue. And the trade wars that are now being built around that. So I think that's relevant to how you view this, how that affects barriers to entry, how that affects levels of investment and rivalry, to some degree even substitutes. So yeah, I think that's a relevant conversation for 5 years from now. So what's your view?
With rivalry and stuff, right now there has to be political stability because of how reliant everyone is on TSM. But as the CHIP Acts come into play and people like Amazon start investing, and people like Apple, Amazon, they're all going to quit being reliant on Nvidia. They don't want, because Nvidia is not meeting their demand. So if the demand for Gen AI keeps rising, they're eventually rivalry is just going to increase. That more people are going to contract out to companies like Intel that are building billion-dollar facilities in the US.
Yeah. And I think if, 50-60% of, talk about Nvidia's business is going to 4 companies, it is in the interest of those companies to create rivals. They want to see rival. It's better for them. So, and if you think about the context of the industry, rivalry will probably get more aggressive in this industry. And the other thing is short-term supply demand balances start to get worked out because back to spending. If people are spending on capacity, then they now have the capacity to meet demand. Well, that's a different environment than when there's more demand than supply. So that could also potentially affect returns and go back to more normal returns. Not saying that they're above average, but a little less so extreme than what you're seeing here today. So rivalry increasing, supplier power increasing, even though barriers to entry are increasing, but barriers to entry might also interfere with this in a different way by the regulations that you're talking about. Because it might, so for example, even today, Nvidia is not allowed because of the US government regulation to sell their most advanced profitable chips to China anymore. And if that expands to other things as well, that could affect the growth of this industry. If we start ended up with sort of these sectionalized areas of the world where you can only sell to. So it kind of tamps down on your market opportunities. Marcos, you've had your hand up for a while.
Yeah, just to add to the point, pardon me, just to add to the point of political tension between the United States and China. There's also other rising manufacturing powers such as India, Brazil, places that could possibly that have an educated populace and could potentially begin to produce similar types of technology that could become substitutes, which in turn increases buyer power because buyers will have more options as opposed to the existing players in the industry.
So what's important in your answers, whether it's in this class or in general, is that you're going to have to develop a point of view. You're particularly talking about the future. Here's what I see happening and why, and being reasonable about it, and then playing out that scenario. And again, try to quantitatively then assess that. What does that mean to the spread? All right. But everything that's been brought up so far is suggestive that we believe the spread is going to be lower in 5 years than it is today. And that net, many of those forces are going to be a little less favorable than they are today, which is why the spread's going down. I mean, that's the gist of the conversation. I'm not saying you can't have an alternative point of view, deal with the future. So we can make the alternative point of view that says, no, the forces are going to get even worse and the industry is going to get even better. But I don't hear anybody saying that so far. William?
Is it realistic though that in 5 years there will be sufficient manufacturing competition such that other chip designers can compete with Nvidia's top of the line chips?
Well, remember, when you're doing the industry, you're not just talking about Nvidia, you're talking about more semiconductor level industry. So that's also getting into the C question of competitive advantage. But time frame is important. Maybe the answer is not as much in 5 years, but 10 years, yes. So maybe it's a longer time frame that some of these things could happen, because that's the other thing. What is the time frame at which these changes occur? And some things happen faster than we think, and sometimes things happen slower than we think. There's always that Hemingway quote, how did you go bankrupt slowly and then all at once? So it could be that type of a change in the industry, or it could be kind of dramatic or not at all. I mean, so those get back to what is your point of view and how this change is going to happen based on what you're assessing.
Yeah, I guess now that I think about it, Intel, ASML is the only one that makes the lithography equipment that TSMC can use to make Nvidia's chips. And Intel backed ASML when they were moving to the next generation of lithography equipment. So perhaps if Nvidia's customers want to see more competition, they can dump a bunch of money and try to innovate in manufacturing or lithography.
Yep.
So
that plays in, and I'll throw one other political wild card in here from what I have read. 2027, 2028, that's the year that Xi has said he wants Taiwan. That's his goal. So if that conflict breaks out, then that also probably completely changes everything we're talking about here at an industry level. Yeah, William?
Given the power that we know TSMC has, though, isn't there a case to be made that China could take Taiwan without armed conflict? That
there's different ways to do this. And again, this is not a political course, but one of the scenarios that I read is that you don't need to militarily take Taiwan to take Taiwan. They could just blockade Taiwan and right. Blockade the country, prevent them from importing or exporting anything. It's not long before industries start to really struggle and collapse. And you can do that without firing a shot. So there are different ways for this to play out. But the point is that political uncertainty is increasingly playing into this industry. It even changed, as you mentioned, like, why is the world want to see Brazil? Why do they want to see India? Why do they want to see Europe, to some degree US, have more manufacturing capacity? That's part of this geopolitical question that's being asked. You don't want 80% of the production of the world's chips in Taiwan. Too much concentration risk. Regardless of whether or not what happens with China and Taiwan. Like, it's just, there's just too much concentration risk of having all your eggs in that one basket. We learned that in COVID. Because when supply chains got disrupted, it was usually because we had a single source supplier and we couldn't get the stuff out of that area. And now we're starting to realize that chips are almost like single source suppliers now to TSMC. So in a way, we need competition as well. That's why in the CHIPS Act, the US has dumped $20 billion into Intel so that Intel can become a contract manufacturer. Yeah, Marcos?
Wouldn't you say that, like, especially during COVID, government legislation led to a huge increase in market share and market and yeah, market share for specifically pharmaceutical companies, especially those who are promulgating. It's not that I'm saying there's anything wrong with vaccination, but especially those promulgating the vaccination, promulgating mask usage, all these things.
Yeah, and it had a big short-term impact on, for example, Pfizer, but it turned out to be short-term because then the government's kind of pulled back on that spending, and we have returned back to a level we're probably below what we should be. But yes, so government forces in the context of this 5 forces matter. And I think what you're saying generally, if I synthesize this, is those forces will probably play a bigger role in 5 years than they're playing today. And that's going to have an impact on the spread. So that's what I want you to eventually take these conversations back to. What's realistic? I mean, yeah, aliens can invade from Mars and kill everybody. I could put that as a scenario, but I don't think that's highly likely. So it's back to what's a realistic scenario? What's the impact? That's the process that I want you guys to continue to talk about. And that's what I'm really looking for here when you're doing your 5 forces. And then the final one is the C, competitive advantage. You know, clearly Nvidia demonstrates competitive advantage. Their spread is higher than the industry average spread. 91.5% ROIC against a 13% WACC is much higher than the 58% ROIC against 12.5% WACC for the industry. So why? Why does Nvidia have competitive advantage today? How'd you guys answer that question? Why does Nvidia have competitive advantage?
I said they essentially had a monopoly on the GPU chips required for AI applications. I think there was a quote that they had like 96% of the market share there, and that's what's blown up in the last 18.
Yep. And that monopoly is around the patents and technology associated with that GPU, and to some degree the relationships with the vendors. So in a way, they're kind of like the Intel of 20 years ago. They're the dominant player with their dominant technology in this fast growing market. Is that going to stay the same in 5 years?
No.
Adam, why not?
They're gonna get replicated. They're gonna find an alternative, and when someone finds an alternative, they'll have to compete. And then they'll start to have price wars from labor and other people doing it and getting it made in Taiwan over getting it made in America.
So the relative spread of Nvidia to the industry in 5 years will be what? Lower, higher, about the same?
I think it'll still be higher, but I don't think it'll be higher than everybody else. I think it'll be competing with other companies.
So they'll still have a spread better than the industry, but it won't be as high as it is today.
Correct.
Okay, Richard?
And I remember like reading up on it a little bit, but it kind of goes back to like business strategy. But the tech industry in general has a very, very good perception of being able to create value within like a platform, which kind of like landlocks companies into having to constantly always use their products and not have to switch over them. Like one thing that makes me think that Nvidia, I mean, obviously their revenues are not going to withstand obviously what they're projected, but I mean, it is going to be a company that's going to be stuck around because you have essentially the big three in tech pouring hundreds of billions of dollars into them over the next 5-10 years. They're not all of a sudden going to be like, okay, I spent $100 billion on 10 years with Nvidia, and in order for me to switch up my systems, I have to completely switch everything out. Which, like, from my understanding, what Jensen Hung is like kind of hinted at is that he's developed these systems in which it does kind of landlock you to using Nvidia in the future. I don't know exactly like the actual technological terms behind it, but that's something that I read that I thought was interesting.
Well, obviously they have a big vested interest in maintaining their lead and maintaining that advantage. So that's why I said this is an open question, but I'll throw in 3 wild cards to the conversation beyond what you guys just said. Right? We said 2 earlier. Photon / quantum computing. Like if that starts to become more practical, that could upend Nvidia's competitive advantage. Because last I checked, I don't think they're the ones that are the leaders of cutting edge developments of those types of chips. And the way it was explained to me technology wise is one quantum computer can do the work of 30 current computers. So it's a magnitude leap in terms of the processing power. And that could play a dent in this thing. Now, whether that happens in 5 years or longer, or whether they can even figure it out, it's a risk to the industry. So that's a risk to their competitive advantage. That's the substitute that we were talking about earlier. I think that's one that could play out. And then the other one, go ahead.
Wasn't last week that we were talking about how they were trying to open up the nuclear power system over in New Jersey or something like that? Because we needed more power to handle all the computing power that we're getting used to.
Well, that's the other is that there are limits on data center growth right now that are beyond just the industry. Like power is a limitation. And if that slows down the ability to open up these data centers, that slows down Nvidia's ability to sell chips, because most of that growth is coming to data centers. And that is in a way an indirect threat to their competitive advantage. And that could be a challenge in the next few years. So that's potential. That's it's going to happen, but that's something at least to put on the radar screen as we're thinking about competitive advantage and the ability to maintain the spread. And then I think the other one that is relevant to this conversation is what was brought up earlier, is that you actively have their customers trying to find alternatives. Because what it was 90-something% is going to Nvidia, like, I want competition. And they're actively encouraging competition. And how does that play out in the marketplace when your competitors are actually trying to encourage competition? So how does that affect their ability to maintain competitive advantage? So there's a lot of things that are at play here, but I think, there's 2 charts in the book that should be burned in the back of your brains. Nothing lasts forever. Growth doesn't last forever, starts to regress to the mean. ROIC doesn't last forever, starts to regress to the mean. Over time, when your standard deviations above the industry average, nobody maintains that forever. Nobody. And so it's a question of how long before Nvidia starts coming back to earth. And that's really the question that we're trying to address, because it's likely that they're going to. Nobody maintains this type of return. Not for 20 years. So how soon? And I guess that's the question. Is it going to happen in 5 years? Is it going to happen in 10 years? 20 years? Don't know. But it's more likely to go down than stay this high. That's what the data historically suggests. So that's our bias. Or should be your bias. EIC. Questions about that assignment? What we've been talking about here today? Or whatever, because the way I'm going to be grading it is I'm going to be, not that there's a right answer, but it's process assignment more than anything else. Did you pull out the numbers? Did you refer to numbers? Did you highlight the data in each of the sections? Did you establish some thought about what could happen in a meaningful way? That's really what I'm looking for here at EIC. Any questions about this before we move on? All right, so back to group projects. Within the next week, you're going to select a company. So back to teams, people, project teams. As of today, everybody's on a team that's registered for this class, right? I had set up 8 teams. Nobody signed up for team 1. So we have 7 teams. Okay. So these are your teams, right? So here's your assignment indirectly for next week. Pick a company that you want to analyze. Okay. And it can't be one that we're going to analyze this semester. So Nvidia's out, semiconductors are out. You got to find another industry, but pick a company in another industry. So you could say Home Depot, you could say Procter and Gamble. You want to go international, you could say Lufthansa. I mean, there's a lot of different companies, industries you can do. And the point is pick one, because what you should start to think about, and I can start helping you give some data, kind of like you had in the EIC assignment, is that in the last week of class, you're going to do a 20-minute presentation. 5 of the 20 minutes is an EIC for that company in that industry. So each part of the class, we're kind of replicating these individual assignments with the group project, and we're going to put it all together. So you might as well start working on it now rather than wait till week 6. So in order to do that, I need to know which companies you want. So by next week, talk to your teammates. If you don't know who your teammates are, click on here. It'll tell you who's on the team, and talk to your teammates, pick a company and industry that you want to analyze. And let me know next week's class. All right, questions about the group assignment that we should be get started. And hopefully, again, everybody's assigned to a team at this point. So find yourself on a team if you didn't pick one of the teams already. And team 1 is now officially gone. We have 7 teams. All right. In the files folder, lecture notes, there's lecture note 2. Okay, so we're going to start talking about that here today. And we're going to get into the second area or section of the class. So if you want to download that, have that available, we'll start that, and then let me share that PowerPoint. All right, second section of the class is called historical, right? And I want to caution us because when we look backwards, we can't drive a car looking in the rear view mirror, right? But we do look backwards to help us understand past performance as a baseline so that we can eventually forecast, right? But we kind of have to understand where we are today to understand where we're going to go. And that's kind of how we're going to think about part of the valuation. So historical analysis. Now, what's unique about the approach we're going to take in this class is the McKinsey approach to regarding Modigliani Miller. So why is this? Where's the Zoom share button? All right. That window a little smaller, having trouble. All right, let's just do this. So this graphic is a representation of Modigliani Miller. And what it says is that a company is worth the sum of its future cash flows, kind of present valued or adjusted to risk. And what we're going to do is we're going to break those cash flows into 2 buckets: operating cash flows and non-operating cash flows. Okay. Operating cash flows are recurring cash flows that primarily come from selling products and services. Okay, so it's what we do. All right, so in Nvidia's case, it's selling those GPU chips. That's selling those chips, operating cash flows. Right, it's why we invest in a company. However, companies can also generate cash and value through things that have nothing to do with selling products and services. Those are called non-operating cash flows. I own a bunch of land. Okay, I've owned it for years, haven't developed, it has value, right? It has nothing to do with selling products, but it has value in and of itself. It's called non-operating cash flows. I have cash sitting in a bank account, right? I don't need cash in a bank account to sell more products, but I have cash in the bank account that has value. So what I'm going to do is I'm going to value the non-operating cash flows separately, and I'm going to add them together to my operating cash flows, and that's going to equal something called enterprise value, or EV for short. I don't know if that was intentional or not, but thank you. So if you take that enterprise value,
Oh, wow.
yeah, that was for all to hear on the recording of all time.
Sorry.
Okay, just remember your mute button next time. Enterprise value is the present value of the operating and non-operating cash flows, and it is that cash that can be paid out to the investors. All right, the debt holders usually get paid back first, and then whatever doesn't get paid back to the debt holders gets the equity holders as a residual. Okay, so to help you understand what's going to be probably the most challenging part of this course, right, as you go through the book and these lecture notes, I've developed a mnemonic. Okay, and we're going to use the mnemonic here in this class. And if you ask anybody about what I'm about to tell you outside of this class, they're going to look at you like you're nuts. Okay, this is something I've solely developed for this class relative to Modigliani Miller. In this class, we are going to call the operating cash flows ones. We're going to call the non-operating cash flows twos. We're going to call the debt cash flows threes. And we're going to call the equity cash flows fours. So 1 plus 2 is enterprise value. 3 plus 4 is enterprise value. Enterprise DCF is 1 plus 2 minus 3 equals 4. Okay, so what we're about to do is, using Modigliani Miller, we're going to take accounting statements and we're going to reorganize them to this Modigliani Miller format. That is McKinsey's approach to valuation. It's an extra step, and it is summarized on this next slide. So on the next slide is an overview of the process that we're about to go through. Okay. And how I clear, try to get rid of the 1, 2, 3, 4s. If I stop the share and reshare, they'll go away. There they go. Okay. So here's the idea. It's a 3-step process. Step 1, we start with accounting statements, income statement and balance sheet. Step 2, we rearrange these accounting statements into an economic format tied to Modigliani Miller. Okay. Step 3, we take these economic statements, which are now in a more cash flow based format, and we forecast them. And that creates the long-term value of a company. Okay. Now, as I said, what you typically learn in other classes is what I call more the direct method. You start with accounting statements and you directly forecast cash flows. What I'm going to teach you is an intermediate step. We're going to take the accounting statements, put them into an economic format, and then forecast. That extra step will take more time. But there are 2 advantages to doing it McKinsey's approach way. Number 1, it gives you a better baseline to understand the past. You'll start to see more clear understanding of what's going on with a company. And number 2, it actually makes the forecast more straightforward. So we're going to do a little bit more work up front, but it will benefit us on the back end. Okay. But regardless, you need to learn how to do this process. And that's going to be part of your next homework assignment. So what do? First, we take the income statement or the balance sheet. Doesn't matter which statement, we got to convert them both to an economic format. And we then rearrange every line item on the income statement and on the balance sheet to this economic format. Okay,
Excuse me, Professor.
go ahead.
Wasn't this assignment, like the conversion, due today?
It was.
Okay. Was that what you were mentioning? You said something was going to be done in the next assignment?
Yes. And so bear with me for a second. So you've already done some of this. So we're going to convert this to the economic statements and then create the cash flows, right? So once we have done this, we're then going to do two pieces of historical analysis. And those are called, number one, the ROIC tree, and number two, the CFI analysis. Okay, so that's what's coming. We're going to do these two historical analysis. Start out with the ROIC trees. Basically, once we put everything into this economic format, right, we will have the drivers of ROIC. And there's two levels. So the first level driver of ROIC says three things will always explain changes in ROIC: tax rate, margin, productivity. Okay. And then we'll have second level drivers which say operating margin comes from the income statement. So what are the drivers of the income statement? Gross margin, SG&A, depreciation, that drive our operating EBIT margin. And we'll have a second level driver from the balance sheet, what drives our productivity. Spending on working capital, spending on PP&E, spending on intangibles drives investment, which drives productivity. So we're going to have first and second level drivers that we are going to go through. Okay. So here is a historical example. Okay. This is a 5-year ROIC tree for Starbucks. Okay. And language, EOI stands for end of year ROIC. Okay. So way to read this is in 2017, on the far left, Starbucks ROIC after tax was 48%, 48.3%. In 2021, 5 years later, it fell to 23.2%. That was a 51.9% drop, 5-year drop over 5 years. Right? Why? Why is Starbucks ROIC lower? Reason number one, tax rate. It's a laser pointer. In 2017, Starbucks paid a 33.2% tax rate. In 2021, Starbucks paid a 21.6% tax rate. That means the tax rate went down by about 35%. Did that help or hurt Starbucks ROIC? If you go from 33% to 22% in taxes.
It helped it, right?
Yeah, should have helped the ROIC, which means the ROIC should have gone up. So the tax rate going down, which is favorable to ROIC, is not why the end of year ROIC went down. Something else must be driving it. Okay, so this is driver number one. Tax rate should have been favorable. If we take out taxes, we have pre-tax ROIC. Pre-tax ROIC, just running the business, selling coffee, 72% ROIC in 2017, 29.6% 2021. So all of the drop in the ROIC was pre-tax. Their business got worse. Why? Driver number two, operating margin. How much profit do they make when they sell a product? So I buy a cup of coffee. For every dollar of revenue, they made 18.5 cents EBIT margin. In 2021, to sell the same coffee, they're now making 16.8% EBIT margin. Is that better or worse?
Worse.
Worse. They are making less every time they sell a product. That is hurting their ROIC. Driver number three, productivity. How much do they spend on their balance sheet to drive $1 of sales? In 2017, to drive $1 of sales, they invested 25.5 cents. To sell the same dollar worth of product in 2021, they're now spending 56.6 cents. Is that better or worse?
Worse.
They are spending more than twice as much to make less on every sale. That is why their ROIC pre-tax is going down. This is the first level analysis of drivers 1, 2, and 3. Will explain the change in ROIC for any business. I will pause. Questions? Second level drivers. What is happening that's causing the operating margin to go down? Why did it go from 18.5% to 16.8%? This is the income statement over here on the right. These three things explain that. Gross margin, price minus cost of goods sold, minus SG&A, minus depreciation, equals operating margin. Okay, so what happened at Starbucks? Their gross margin went from 35 cents to 34 cents. Is that better or worse to the operating margin? Do you want to have a higher or lower gross margin?
Worse.
That's worse to the operating margin. They're making price minus cost 1 cent less, 1.2 cents less every time they sell a cup of coffee, which means their price went down or the cost of coffee went up. They got squeezed on their margins. The second driver is selling general and administrative, also known as overhead expense. In 2017, they spent 13.8 cents on SG&A. In 2021, they spent 13.4 cents on SG&A. Is that favorable or unfavorable to operating margin?
Would be favorable, right? Because they're not spending more money on.
Correct. It is slightly favorable by 0.004 cents. Driver number 3. In 2017, they were spending 4.8 cents per dollar on depreciation. In 2021, they're spending 5.2 cents per dollar on depreciation. Is that favorable or unfavorable to operating margin? Here to here.
Unfavorable.
That's unfavorable. So the gross margin went down by a penny, right? SG&A improved by 0.5%. Depreciation improved by another 0.04%. But it was really the 1.2 cent decline to gross margin that overwhelmed the other two. And their operating margin went from 18.5 to 16.8. So it's the drop in gross margin that hurt them. And a slight increase in depreciation. So it's like these two cancel out. And this is the driver down. Everybody see that? Why did they go from spending 25 cents to 57 cents on the balance sheet to drive $1 of sales? I'll start out with PP&E. 22 cents of PP&E to sales. PP&E is property, plant, and equipment. That's the stores and all the equipment inside. Okay, so I'm spending 22 cents per dollar on my stores. Now I'm spending 50 cents per dollar on my stores. So I'm spending a lot more on my stores to sell the same coffee. That is a big driver of why they're spending more money. Driver number 2, intangibles. Okay, they were spending 9 cents per dollar on goodwill. Now they're spending 14 cents per dollar on goodwill. Is that better or worse from a productivity standpoint?
Worse.
What causes goodwill to increase?
Acquisitions. Ooh.
So when do they see the biggest jump in goodwill and intangibles? What year?
17.
2018.
Right here. Big jump in goodwill and intangibles. Why? They likely bought somebody, right?
You think maybe Part more land to buy more stores.
So here's the question, who'd they buy? This isn't building more stores. That would be in PP&E. This is literally buying another company.
Okay.
They bought somebody. So we know they bought somebody because the goodwill went up by 10 cents per dollar. So the question is, who'd they buy? You should know the answer to that, right? As part of your assignments going forward. Right? If you're analyzing a company, see a big jump in goodwill, why'd it go up? Who'd they buy? That's an obvious question. You should be able to answer that. The third one, I skipped over this. This is actually the first one. OpWC is operating working capital, right? It's primarily receivables, payables, and inventory, right? Now, Starbucks has negative working capital, which means they have more payables than receivables and inventory. They have negative working capital of negative 5 cents. Is that good or bad? Financially.
Bad.
Why is it bad? I have more liabilities than assets. Why is that bad?
Because if that continues, you're gonna have to liquidate some of your assets to pay out your liabilities.
Or I have to have at least the cash or the access to cash to pay it.
Yeah.
Yeah. But if you take that out, from an investment standpoint, negative working capital lowers invested capital. So it does lower your investment in the business. I get my suppliers to basically fund my business, right? So negative 5 cents from an invested capital standpoint, assuming there's not negative consequences, not being able to pay it back or pissing off your suppliers, that's favorable to the business. They went from negative 5 cents of working capital to negative 7.5 cents of working capital. Did that help or hurt invested capital to sales?
Hurt.
It helps it, right?
Add this plus this plus this, you get that. If this goes more negative, when you add them together, this goes down. So that financially benefited them. So benefit, hurt. But these two went up so much that the 2.5 cent benefit was swamped. And overall, they're spending a lot more to sell the same product. So when you go through the tree left to right, you summarize right to left. Summarize. A big increase in PP&E to sales from 22 to 50 drove invested capital from 25 to 57, which combined with a drop in operating margin from 18 to 17, which was driven by a drop in gross margin from 35 to 34. These two factors, margin declining and productivity worsening, led to the pre-tax ROIC dropping from 72 to 30. Slightly benefited by a lower tax rate, 33 to 22, but the overall ROIC went from 48 to 23. Those are the dots that I need you to connect. When the training wheels are on, you can start with years 1 and 5, but very soon I'm going to want you to care about the years in between. And what you're doing as you're going from left to right is you always want to connect it to the level up. Why? If the ROIC is going down, why? Is the tax rate changing that ROIC? Is the margin changing that ROIC? Is the invested capital changing the ROIC? And if so, in what direction, favorable or unfavorable? Then, when I go to the second level, what's driving the margin up or down? Is gross margin favorable or unfavorable? SG&A favorable or unfavorable? Depreciation favorable or unfavorable? Connect it to the level above. Same thing. Productivity, better or worse? Am I spending more to drive sales? Am I spending less to drive sales? Is it because working capital is getting more favorable or unfavorable? PP&E more favorable or unfavorable? Intangibles more favorable or unfavorable? Connect these dots to explain that. Connect these dots to explain that. Connect these dots to explain that. That's what we're trying to do when we do an ROIC tree. Questions before we do another example? William?
Can you please restate or review why the operating working capital going more negative helps?
Well, the whole point is this number here, invested capital, is this plus that plus that. It's the sum of these three things. So the sum of these three things equals that, right? So here's the point. If that goes from a number to a smaller number, invested capital goes down. So more negative working capital lowers invested capital. And if I have lower invested capital, all things being equal, ROIC goes up. If I have more invested capital, all things being equal, ROIC goes down. So when I spend more money to drive sales, ROIC goes down. When I spend less money to drive sales, ROIC goes up. Now, there's consequences to not paying your bills, but assuming I'm not facing those consequences, all things being equal, financially, less invested capital, less or higher ROIC. So less working capital, less invested capital. That's what more negative working capital means.
Thank you.
Let's do a second example. Here's Target. Okay. 5 years of ROIC for Target. Okay. A little faster. ROIC for Target went from 13.5% to 20.5%, a 52% 5-year increase. Tax rate went from 33 to 21. That was favorable. That helped the ROIC for Target go up. But that wasn't the only reason, because the pre-tax ROIC went from 20 to 26. Why? Driver number 2, the profit. Margin went from 7.2 to 7. Virtually flat. So nothing really changed much of other profit margin, their EBIT margin. So why the ROIC get better? Because invested capital to sales went from 35.7 to 26.8. So for Target, their pre-tax ROIC is going up because of store productivity. They're spending less to generate the same amount of sales. Okay. And their margins are staying virtually flat, 7.2 to 7 cents. Okay. So make the same margin, spend less to make it. Okay. Why? What changed? Did anything change about this margin when 7.2 to 7? Well, their gross margin actually went down. Price minus cost. They're not making as much when they sell your product at Target. They went from 32.6 to 31.9. Their SG&A went from 22.1 to 22.3. So they spent about the same, slightly more. But their depreciation went from 3.3 to 2.7. So if you really look at it, what's changing here about the operating margin? The gross margin's going down, the SG&A is flat, and the depreciation is kind of going up in a beneficial way. They're spending less in depreciation, but that's offset by the lower gross margin. So these two are kind of canceling each other out, and this is flat. That's what's changing about Target, but there's some change here at Target. Invested capital sales, why are they spending less? They went from basically 0 to negative -0.5 cent in working capital. That was favorable to invested capital. PP&E went from 35.5 to 31. That's called store productivity. I'm getting more out of my stores, more revenue for less store investment. And intangibles went from 0 to 0. They don't really buy anybody. Okay. So really, what's driving Target's ROIC higher? It's right here. Store productivity and working capital improvements. There's 5 cents. There's 4 cents. That's why it went down between here and here. This was flat, which drove the ROIC higher, because this times this equals that. This times 1 minus that is this. Tax rate benefited them. So this is favorable tax rate, and this is favorable productivity. What's driving the productivity? PP&E and working capital. Those are the dots I need you to start to connect. Why is the ROIC changing? In a structured approach. Once we convert things into economic format, these trees get really easy to build. Questions, comments, concerns, crippling fears?
Can you explain the operating working capital again and how that helped the invested capital?
So I'll do it graphically. What is working capital? And I'm a little oversimplifying because we're using a more formal definition of operating working capital from the video, but it's primarily I tie up inventory for a period of time. So it's my inventory. So I got to invest in that. How much inventory do I have? Then I sell my product and I have to wait to get paid. That is called accounts receivable or day sales outstanding, AR. So that's what I'm financing in working capital, right? But one thing that can offset this is how long it takes me to pay my suppliers. That is called accounts payables, trouble drawing with my mouse, AP, right? So just data, making it up. Let's say I have 50 days of inventory. Let's say I have 30 days of accounts receivable. That means I'm tying up cash for 80 days. But let's say I pay my suppliers in 90 days. So my supply chain is completely covering my inventory receivables. That's negative working capital, right? More common, I have 50 days of inventory, 30 days of receivable, 30 days to pay suppliers. So I have 50 days of working capital, a positive working capital. But in this case, for Target and Starbucks, their accounts receivable is pretty negligible, right? Starbucks is basically getting paid cash or by credit card. So they don't wait 30 days to get paid. They're getting paid within 2 days by the credit card companies, right? So really, they just have to finance their inventory in the stores, which is perishable. So they don't have a lot of inventory in their stores, and they pay their suppliers in 45 to 60 days. And they're getting paid by you in a couple of days. They got 20, 30 days of inventory on hand. So they have negative working capital. Same thing with Target. The goal of retailers, a low margin, is I want to pay the suppliers after I get paid by a customer. So get the supplier to put it on my shelf, flip it to a customer, take that cash to pay back the supplier. So that's negative working capital. That's what's happening at Target and Walmart and Costco and companies like that. Does that conceptually make sense?
Yes.
Okay. So here's what we're going to do. Break and practice. I'm going to give you something real and practical. So here is, I'm going to put this in the chat. But next week, I am working with a company called RTX, which used to be called Raytheon. And we're going to be doing some benchmarking, real. And as part of that session, I put together publicly a defense and aerospace benchmarking case. I am putting it in your chat. And I'm going to also put it into the files folder. But for convenience, I'm going to put it in the chat. Or try. Click and drag. Copy. So you can either download it now, which I'd recommend, or I'm going to put in the files folder in a minute. Okay. What's in this file, all public data, is 5 years worth of ROIC tree for the defense and aerospace industry. And so the companies, let me go ahead and reshare this in Zoom. The companies include RTX, there's their 5-year ROIC tree, Lockheed Martin, Boeing, General Dynamics, General Electric, HEICO, Howmet, Leidos, L3 Harris, Northrop Grumman, Rolls-Royce, Textron. Okay. And so, and by the way, Rolls-Royce is about jet engines, not cars, stuff like that. So, but so long story short, 5-year ROIC tree. I added one thing that is not in the ROIC tree I showed you in our binder, which is the 5-year growth rate. So this is the growth rate year by year the company is growing. So you got growth and you got return. This is the ROIC tree next to the growth rate. So for the analysis purpose of the analysis, right? So what I want you to do is I'm going to put you in random teams. And as a team, I want you to do a 5-year ROIC analysis of RTX against one of the other companies on this list. So explain their 5-year ROIC change, explain the other company's 5-year ROIC change, and tell me who's doing better and why in the 5 years of the ROIC. Okay, clear on what I'm asking you to do? All right, so we're going to include this in a 15-minute break or 10-minute break, whatever. And I'm going to give you 30 minutes to work on this. And so at approximately 8:25, we're going to reconvene and talk this through. And I'm going to ask each of the teams to kind of explain that ROIC. And by the way, this is part of your homework assignment for next week, right? Except there'll be different companies, right? Make sense of what I'm asking you to do? All right, so I'm going to put you into teams, and essentially what I need you to do is team 1. So you'll see the team names. Okay. I want you to look at RTX versus, I don't know, Lockheed Martin. Okay. So team 2, RTX against General Dynamics. Team 3, teams do we have here? Let me see, teams, how many teams are we going to have? I'm going to make teams of 5 to 6 people. So teams, breakout rooms, what do we got? 6. How many people are here? 41. So 40. So 6 times. All right. I'm going to put you in 7 rooms. So room 1, when I do this, if you're in room 1, which is Adam, is it Suppley?
Yes.
Right? You're doing RTX against Lockheed Martin. Room 2, is it Ayuk, Manda? Did I pronounce that right?
Yes.
Okay. You're going to do RTX, your room, against, we'll have you do RTX against Boeing. Room 3, Eleanor Campbell, you here?
Yes.
RTX against General Dynamics.
Okay.
Room 4, Alex, is it Rutigliano?
Yep.
I want you to do RTX against Northrop Grumman. Room 5, Felicity, are you here?
Yeah, I'm here.
RTX against Textron.
Okay.
Room 6, Ahmad, are you here?
Thanks. The mute button. Yes.
I want you to do RTX against General Electric.
Okay.
And room 7, Lucas, you're on that team? Lucas, are you here?
Yep.
I'm going to give you dealer's choice. So you can have any company that I did not assign. Your team can pick one, RTX against that company.
Did you do Boeing yet?
We already picked Boeing. So Boeing, General Dynamics, what do we say? Leidos, Rolls-Royce, Textron, Lockheed Martin, taken. You could pick somebody else. And General Electric taken. So you could have Heiko, Howmet, L3 Harris, and Rolls. You could choose one.
You said we could have Rolls Royce.
You can have Rolls Royce if you want. Jet
Do
engine.
that one.
Okay. All right. So I'm going to set the timer for 30 minutes, including a break, and then we will debrief on the other side. This is called the ROIC tree analysis. Questions before I send you out? All right. I'm also going to put this in the files folder if you don't have it from the chat. Good luck.
You said you want us to focus on the 5-year gap, right? Or do you want us to look in between years as well?
Do the 5-year change for each company, be able to explain it. And all right. I don't know if you're all in the rooms yet, but basically 5-year change. Who's doing better than what? Should have an option to join.
Okay, great. Thank you.
I just had an announcement. See you on the flip side. Sorry, I was on mute. I was gonna say, room one, why don't you kick us off? Adam's team, share your screen, show us your findings of the ROIC differences between your two companies and who's doing better.
Yeah, I can jump in. Let me share my screen here. So we were RTX to Northrop.
All right, go ahead.
You want me to go through RTX because everyone's doing it, or?
Yes.
Hold up. Hold up.
Yeah, wait, well, I think we're
Hold
early,
on.
bud.
Hold on 1 second. Will's in my like project group team.
All right,
Not
so he
this
wasn't in
breakout
room
group
one,
team.
but that's okay. We'll let them kick off since they were sharing.
Yeah, you can go, Will.
Well, you're up first. Go ahead. Do RTX versus, you said Northrop Grumman?
Yeah, sorry. For some reason, I thought we were team one.
No, man, you're good.
You're up first. Go ahead. So
Yeah,
share.
so we saw RTX it has a 40% decline in ROIC. They saw an increase in their tax rate. We saw that with Northrop as well. It's primarily driven by their drop in pre-tax ROIC. They actually got more productive. Their invested capital per sales dropped, driven by significantly decreasing their working capital. They did see some marginal improvement in PPE per sales, but nothing. I don't think anything like crazy significant. Mainly the working capital driving the invested capital. I think the real story here is on the gross margin side, seeing a 20% drop in their gross margin. They did, become a little more efficient, less on SG&A. Their depreciation increased slightly, but it's pretty much the same. So when we go look at Northrop,
before you go there, I would say a good start, but two things. Connect the dots, meaning I'm sure you're doing this tacitly in your own mind as your team was talking about it. But when you said for example, working capital got better. What did that mean? Like working capital got better, which reduced invested capital. Gross margin got worse, which reduced operating margin. Connect those dots as you're going through this. Don't just use the numbers in a vacuum, if you know what I'm saying.
Yeah, that makes sense. Understood. Thank you.
That's why I want everyone to be able to do this. So whether you're doing this yourselves or not, this is what's going to be important for your grades. Is can you show me that you can connect up across the tree, not just with reading the numbers that you see. So anyways, otherwise, good job. So go to the next one.
Yeah, thanks for the feedback. In Northrop, we see a very similar story. So a drop in ROIC over the 5 years, minus 38%. Again, this is going to be primarily driven by what's going on in their margin, but just to take a cursory glance at everything else, their tax rate did go up less than RTX. It went up by 5% versus 11%. But their overall tax rate is comparable. It's 12.4 versus 11 point something else.
Okay.
So looking at invested capital per sales, it also dropped, as did RTX's, by 11%. So they got more productive, and this is again driven by working capital. So our working capital got more negative and drove the decrease in invested capital. They saw PPE increase, as well as a decrease in the intangibles, and we figured this like roughly canceled, and that the drive in invested capital per sales was primarily a result of the drop in working capital. Nonetheless, we think that the primary driver of the decrease in ROIC of 38% overall isn't the increase in productivity, because that should help. It's the operating margin dropping significantly. The gross margin dropping is the primary driver of the operating margin decrease. It's minus 20.3%. Interestingly, coincidentally, it's the same drop in gross margin over those 5 years as had RTX. And similar to RTX, they had some slight movement in SG&A and depreciation, nothing super significant. So really the story is that gross margin dropped over the 5 years. Their tax rates are comparable. They both got more productive in invested capital, but ultimately it's the operating margin decreasing, which is decreasing their overall ROIC.
So adding a couple things, this is for all groups as well. Be careful. I know I put the 5-year change on there, but a big change in a small number might be not as important as a small percentage change in a big number. So for example, the 5 points gross margin is much more important, 5 percentage points, to the drop in the operating margin than for example, 5% increase in the SG&A, just because of the magnitude of what we're talking about here. So just make sure you be careful about when you do percent change. The other thing is that you missed a decimal place when you talked about working capital, meaning it went from 0.002 to 0.007 negative. That's pretty negligible. So all the invested capital sales was not because of the change in working capital. It was actually the drop in the intangibles, because that went from 58 to 45. So that's the 9-point drop of invested capital sales. I think you just got confused by the decimal place there.
Okay, thank you. Yeah, that was not clear to me.
But the real question is, who's doing better, RTX or Northrop Grumman over the 5 years? When you looked at the two,
I think we're pretty split on this. My view is that RTX is doing better. They had to recover from a pretty significant drop in ROIC in the first year here, from 2019 to 2020. And Yeah, I don't really have much more to add off the top of my head.
You said split. What was the other view of the team?
Well, one thing we discussed is it seemed like, I mean, this is an assumption, but seeing that the gross margin dropped by an equivalent percentage across both firms, that there seemed to be perhaps something going on in their respective sector. And that, well, I guess you can make the case that RTX dropping by 52% in their operating margin means they're faring worse, all things being equal, than a drop of 44% by Northrop.
Okay. So back to the answer, is it better that they kind of dropped and improved, or is it that Northrop Grumman was just consistently better in ROIC over the 5 years? You could probably make the argument that's probably the consistently better ROIC over the 5 years, because that was your company, right?
Correct.
So those ROICs are consistently higher. And it dropped, but they still generally had higher rates of return. So I would argue that Northrop Grumman's probably doing better over the 5 years.
Yep, that's clear to me now.
So let's go to the next company. Somebody in the chat said their AirPods are dying and they wanted to go next.
Hey, yeah, sorry, that's me. Is that okay?
Yeah, go ahead, Ryan. What group are you guys?
5, I believe.
All right, so we kind of heard RTX, unless you have anything to add. So just kind of give your comparable company.
Sure, let me share my screen. Give it a second. Where am I? Kind of blind here. Where's the share my screen? Oh, here we go. All right, here we go. Great. Okay. All right, exist. So our so we had Textron for our other company. So getting into the very basic. So they did have a negative ROC change over 5 years. A bigger drop in 2020. So first going to their tax rate, the tax rate did increase by 12%, but it wasn't anything too crazy. So going into their pre-tax ROC, they had a small dip in this, which is kind of driven by two things. So their operating margin went pretty badly, a decrease of 22% over 5 years. And notably, you can see it's the biggest decrease in 2020. And so this was driven by a large increase in SG&A. They did have a small decrease in depreciation and a small increase in gross margin. But just looking up a quick article, they did have some lawsuits filed by their shareholders in 2020, and they kept appealing this lawsuit. So you can see the big increase in SG&A does start in 2020 and kind of continues on. So we think this is the main thing that kind of murdered their gross margin over over their operating margin over the 5 years, and that kind of contributed to lower ROIC. As you can see, they're getting more productive over the 5 years. They've been investing less money to get sales, and the intangibles are not really related too much. Pretty much no change in intangibles, no change in property, plants, and equipment, and just a change in operating working capital. So they're either collecting money faster, or they're paying their vendors later, or they've optimized their inventory in some way. But they've seen a decrease in here, which is helping them out, but it's not helping enough to offset their bad gross margin, which we think is mainly driven by maybe legal expenses, because that's one of the big SG&A expenses. So over the overall over the 5 years, they have been seeing like pretty much stagnant revenue growth. They've gone down and gone back up. So they pretty much, the revenue growth from 2019 to 2023, there wasn't really I'd say a large change. But if you compare that with what RTX is doing, significantly worse. They have a worse ROIC every year. But one I guess explanation we thought about RTX is, so they did have a big rise, or they have a little bit of rise in intangibles in 2020, and they also had a rise in some of their SGA, and they reduced gross margin in that year. So I guess they did one big acquisition they Raytheon had in 2020 was United Tech Corp, which the aerospace industry, is, I'd say, a little more fickle maybe than defense. and that resulted in them having to spend more money and be less efficient, especially in the first year. I think it kind of looks like based on the graph, they got better over time, but we think that's one of the other reasons why their ROIC is worse. So I think in the 5-year span, we all agreed Textron was doing better, but we said maybe and potentially because they have, when you have these big acquisitions like this, you can't expect a payoff immediately. So maybe over time they'll see higher revenue growth and higher returns. But we all thought that Textron was a better company in the 5-year period.
At least financially. Okay. I want to highlight one other thing.
Sure.
What is the level of invested capital to sales at Textron? Approximately.
What level invest? I mean, what, the 4 cents or 54 cents per dollar, 55
Okay.
cents.
What is the level of invested capital in RTX?
1.5.
So how much more is RTX investing to generate sales than Textron?
About 3 times that.
And is that affecting their ROIC?
No, it's not helping their ROIC at all. Oh, sorry, it's helping Textron's ROIC. Yeah.
Yeah, but it's hurting RTX. So
Yeah,
that's the other big difference. Like the difference is RTX, which did this major acquisition, has a lot more investment now on their balance sheet. And that investment is really weighing down their ROIC.
Yeah.
And so Textron, for, margins that are somewhat similar, 7-cent margin, 7-cent margin RTX,
Yeah.
is getting a better ROIC because they're investing 1/3 of what RTX is investing. Does everybody see that?
Yeah. Yeah, I see that. Yeah.
Okay. All right. Good job. How about who's next? Who wanted to go next?
Yeah, I'll go next.
All right, Noah.
General Dynamics. Oh, here, I'll share my screen.
And again, since we've already been talking about RTX, you can focus on GD unless you have something you want to specifically add for RTX.
I do not.
Okay.
Alrighty, so here's General Dynamics. You'll see that the end of the year ROIC did not change so much. It dropped from 11 to 10%. When looking at tax rate, it actually fell. So we didn't think that that had much of an impact. And so we looked at end of the year pre-tax ROIC, which dropped from 13.2% to 12%. And we thought that this could largely be traced to gross margin all the way to the top right, which went down 10.3% from 19.9 cents on the dollar to 17.8 cents on the dollar. And when looking at SGA, that actually fell, depreciation fell, sales, the operating fell 2%, but we thought that the drop was largely due to the gross margin discrepancy from 19 to 23. And then when comparing it to RTX, we thought General Dynamics was in a much better place, just falling 9%, and ROIC from 11 to 10% versus the much more dramatic fall in RTX. I think it was like around 39% or so.
Okay. So again, who's doing better?
General Dynamics.
Okay. Pretty clear to everybody? And again, what's the primary reason why General Dynamics is doing better for ROIC? Like, think about the main 3 drivers. Which of the top 3 drivers are they really outperforming on?
The 3 drivers where they're not performing?
No, why is General Dynamics doing better? Is it tax rate, operating margin, or invested capital to sales? Where are they really doing better?
Well, I think in tax rate and in margin as well.
Right. And they're spending less to generate sales. It's all 3.
Oh, okay.
You see that?
Yep.
All right, good job. Next.
I can go next. I can do the very entertaining Boeing.
Okay. Yeah, let's talk about the disaster that is Boeing.
Go Spence.
Oh my God.
Can I share? No, can you stop sharing?
Yeah, I'm trying to figure that out. Sorry.
It should be
Oh yeah, I got it.
bottom. Okay. All right, let's hear about Boeing.
So Boeing is as fun as it has ever been. There's been some plane crashes you may or may not have heard of. But yeah, so let's talk about Boeing. So Boeing's ROIC has been very negative. It dropped from negative 1.9 to negative 3.2 with some sporadic years in there, like peaking in 2020 of negative 29. So why is this so bad? So their tax rate luckily has gotten slightly better because they are losing money. We go from a 78% tax rate, so paying lots of taxes, to the government actually paying them with the negative tax rate. So that's fun and good, but it really doesn't matter because your pre-tax ROIC is still negative. It's getting better. We went from 6.8 to negative 2. So we are getting better, but we're still very, very negative. Operating margin in the same way is cut in half. So they're only losing about 1 cent per plane, when before they were losing about 2.6 cents per plane. So that's good. Invested capital, they're also not investing as much to lose as much. So I believe it was said the other day, like they're not spending money to lose money. So that's pretty good, going from 38 to 34. Their gross margin is getting better. So over time, we're seeing that go from 8 cents to 12 cents. SG&A is getting slightly worse, going from 8 cents to 10 cents, but this gross margin is overpowering that. That's why you're seeing the operating margin decrease. Depreciation, again, that is also going down. So that's also helping it. So gross margin and depreciation are helping your operating margin actually get slightly less negative. From a working capital standpoint, that did slightly tick up. So, I mean, Boeing's kind of been a little sporadic here, going from like 5 cents to 20 cents back to 5 cents. So it's hard to say they've had a trend in any direction when they're kind of all over the place, but that did tick up slightly. PP&E ticked down slightly, and intangibles also ticked down slightly. Those three combining to get your invested capital slightly down. So why is this a negative ROIC? Really, none of these factors alone explain it. So it's mostly because they're selling a lot of negative. So that's kind of why you're seeing this negative trend, is the more you sell, the worse you are.
That negative operating margin, yeah. Although it's getting slightly less negative over time, as you did point out.
Yeah.
Okay. So thank you for explaining that challenges that Boeing is facing. So clearly RTX is doing better than Boeing. So
yes,
obvious one. Okay, who's next?
Our team can go next.
Great.
Sweet. Allow to share screen. This screen. All right. Okay. Everyone can see my screen?
Yep.
Perfect. All right. So taking a look at Lockheed Martin, they do have the highest ROIC in the industry. So competitive advantage there. With that, we're taking a look at, what's causing the decrease. They went from 28.6 to 27.5. Part of it can be attributed to tax rate, but not a significant amount. It's 14% versus 14.5 in 2023. Again, pretty much like everybody else, where it really comes, what the really driving factor is, I should say, is the gross margin. As you can see here, pre-tax ROIC is 32.1, and the operating margin is actually less than Boeing's, but where Lockheed Martin kind of distinguished itself is, yes, the gross margin is lower by, 0.09. They do not have much SG&A, so basically zero SG&A, and depreciation is slightly less than that of Boeing's. In terms of invested capital as well, so Lockheed Martin's more efficient with its resources. So where you see a decline in invested capital here, RTX again is at that 1.52%, 1.52 figure. The working capital and PPE and intangibles. So for RTX, I'm sorry, for Lockheed Martin, I should say, what affected this was primarily the high intangible. Oh, I'm sorry. The difference, I should say, between the two is the high intangible assets for RTX. Lockheed Martin has a much lower, so they're not doing a ton of acquisitions here. In addition to that, you can see that the working capital is actually higher for Lockheed Martin. But again, what sets Lockheed Martin apart here is the fact that their operating margin is much higher than Boeing's.
Okay. So two things. One, I think you kind of correctly pointed Lockheed Martin's doing the best in the industry because they have a combination of some of the highest operating margins and some of the most efficient invested capital sales ratios. You put those two together, it really helps their ROIC. The other thing is just, I didn't tell you this, but Lockheed Martin, when you get to that gross margin and SG&A, don't those numbers look a little weird?
They do, yeah. We were trying to figure out what could be causing SG&A to be negative, because I guess, and correct me if I'm wrong, does that imply that they're making money off of some overhead?
Does everybody know what GAAP stands for?
Generally accepted accounting principles.
Which means there's supposed to be rules everybody follows when they report the results.
Yes.
Lockheed Martin does it differently. They do not break out SG&A and cost of goods sold on their balance sheet. They just lump it together as operating expenses. They're the only company in the industry that does it that way. Their accountants let them do it every year. So that's the reason. It's not that they don't have SG&A. It's just they put SG&A in their gross margin.
Got it. Okay. All right. That makes a lot of sense.
It makes it harder to compare them against the peers because they do it in a unique way. So operating margin's comparable, but gross margin SG&A are not. And that's just a challenge with Lockheed Martin, just FYI.
Yep. Thank you.
Okay. Good job, by the way. Who's next?
I can go next. We were General Electric.
Great. Let's see how the once great and mighty GE is doing these days. Lockheed, stop sharing, Logan.
Yes. Thank you. All right, so for General Electric, we see that the end of year ROIC goes down from 44.9% in 2019 to 11% in 2023. However, when we look at the pre-tax ROIC, we see it goes from 4% and then it increases to 12.4% in 2023. So first explaining why the pre-tax ROIC goes up, we see that the operating margin is pretty consistent, so I'm not going to highlight that one. So whereas we saw with RTX, the operating margin was kind of driving the change, instead here we're going to look at the invested capital to sales, which goes down from 0.967 to 0.309 in 2023, which is driven by a decrease in your working capital for sales, goes from a positive 0.044 to a negative 0.156. Your PPEP for sales, which is 0.509 down to a 0.184, and then your intangibles for sales, which goes down from 0.414 to 0.281. Our group did a little bit of research into what was going on with General Electric at the time. So they basically spun off a bunch of their company in 2023. So they spun off, it was aviation, healthcare, and energy, basically only keeping aerospace, which could account for some of the decreases we see, which then decrease the invested capital per sales, which then should cause your pre-tax ROIC to go up, which it does. However, we also see the tax rate in 2019, it was very abnormal. It was a negative almost 1,000%. And then it went up to 11.4% in 2023, which counteracts with your increase in your pre-tax ROIC to give us a decreasing end of year ROIC. Overall, though, the numbers are higher than the RRTX. However, we'd want to see, we also, have lower invested capital for sales, especially in the earlier years than RTX. However, our group would want to see a little bit more after this huge change in their structure before we'd say one is better than the other.
Okay, good job at linking to what they've been doing. So it sounds like their spin-offs / shrinkage has actually been helping them because they've been getting rid of a lot of high capital assets and focusing on the ones that are a little bit more efficient. And that's been helping them. So appreciate that part of the story. All right, who else is left?
Us. We did Rolls Royce.
Okay.
Let me share my screen here. All right, so Rolls Royce, I think the one thing that we also noticed with RTX was the revenue growth was steadily declining. That was in contrast to what we saw here with Rolls Royce as well, where it's been increasing between 2019 and 2023. You can see their ROIC has increased dramatically from a negative 14.1% in 2019 to 19% in 2023. That's been mainly driven by their pre-tax ROIC here, which increases from the negative 9.6 and 19.2. Tax rate's a little weird. We also had some negative tax rates here. They posted some losses back in 2018 and went through a lot of restructuring. So it may be the reason why we're seeing the negative tax rate. But the main driver here, the improvement in the ROIC, does come from their margins. Looking at their operating margin here, that was a significant increase between 2019 and 2023, going from a negative 5 cents on the dollar to a positive 10 cents on the dollar. This again is being driven mainly by their gross margins, which got significantly better over that period, going from 13 cents on the dollar to 28 cents on the dollar. There was a slight decrease in depreciation, which also helps, but mainly that drastic difference there in the gross margin is the main driving factor on the operating margin. On the invested capital side, there was a slight decrease in their invested capital. That's been mainly driven by both their PPE over sales as well as their intangibles over sales. We did see that they went through some restructuring here in the late teens, which may be driving that. So those two drove the invested capital over sales to go down from 0.6 to 0.56. So in our opinion, Rolls-Royce seems to be in a better trajectory than RTX. They have better margins and a better ROIC, and so we picked that as a better company.
Okay, makes sense. Sounds good. Was that every team, or did we have one company left? I remember. No one else had a different one? All right. So again, what you did, and this is part of your homework assignment that's coming up, is ROIC tree analysis. And you know what I said in the video and at the beginning of the class is, you know, once you kind of put these things into this format, it starts becoming a little bit more clear about what's happening with these companies, particularly with their ROICs. And this will help us when we eventually forecast. But nonetheless, it's really useful to kind of understand what's going on when you put these formats together, because it's pretty clear about what the drivers are. So that's kind of the ROIC tree analysis. So questions about ROIC tree analysis? All right, here's what I want to do. I want to take a 5-minute break, and then we got one more, which is the CFI analysis that we want to talk through, which is going to be part of your assignment for this coming week. So 5-minute break, come back, talk about CFI. So 9:05. So as we come back from the break, the last thing I want to talk about tonight is what I'll call CFI analysis. So again, looking historically, this gets back to, we took our financial statements and created the CFI in the 4-box Modigliani Miller format. And so what we want to do is we want to explain the drivers of CFI, which means we want to explain what happens with all four of the cash flow boxes, right? But where we start is with the drivers of free cash flow. So here is 5 historical years of Starbucks CFI, and the total is the sum of the 5 years, right? So I'm going to start with the total column, but ideally you don't want to just do the total. You also want to talk about what's happening in the 5-year trends, but regardless, we're going to at least start with the total column. Every CFI analysis actually starts here. With free cash flow. So Starbucks had $3.2 billion worth of free cash flow over this 5-year period from 2017 to 2021, right? Now, this is important because it's going to frame how you do the analysis. If a company has positive free cash flow, the rest of the analysis is pretty much, what did they do with the money? Where'd it go? If the company has negative free cash flow, then a lot of the rest of the analysis will be, how do they fund it? How do they fund the negative cash flow? So we start with free cash flow, and it's telling to how the rest of the analysis is going to be framed, right? But first of all, why does Starbucks have $3.2 billion worth of free cash flow? Well, they had $20.99 billion of gross cash flow coming from the income statement. They reinvested $15.96 billion back into the balance sheet, leaving them free cash flow before acquisitions of $5 billion. They spent $1.8 billion on intangibles and goodwill and intangibles, leading to $3.2 billion of overall free cash flow. Okay. Now, 2 other things. One, if I'm reinvesting $15.9 billion of $21 billion, that represents an average reinvestment rate of about 76%. So on average, Starbucks is reinvesting 76% of its profits back into the business, which means 24% is theoretically available to be paid out, right? Now, point number 2, CapEx to depreciation, right? Rule of thumb, we need to reinvest depreciation to tread water, right? If we're not reinvesting what's depreciating, then the business is going to start to go in decline, right? Not say it's always going to be that way, but that's kind of a rule of thumb. You got to reinvest your depreciation to maintain what you have, right? So when a company spends much more than depreciation on CapEx, 247% on CapEx, so $2.47 on CapEx for every dollar depreciation. Why would they do that? Why would I spend a lot more on CapEx than depreciation?
Expanding, so opening new stores.
It's a growth signal. And if I spend a lot less than depreciation on CapEx, what would that be signaling?
Shrinking.
Yeah, because if I'm not building back what I have, like, I'm not thinking I'm going to sell a whole lot more stuff, right? So I'm telling you that there's a little bit of a short-term signal here in the CapEx to depreciation ratio, particularly for the last year, because what they do in 2021 is kind of a signal to what they think growth is going to be in 2022, right? So notice what happened at Starbucks. Their CapEx depreciation ratio peaked in 2020 at almost 600%. And then in 2021, it's the lowest it's been in the last 5 years. So what does that suggest?
Did they overexpand in 2021 or 2020, excuse me, and they're clawing it, like dialing back in 2021 to compensate?
So I don't even need to show you the analyst forecast for 2022 and beyond, but I'm going to be willing to bet they're going to be slowing their growth because they're already signaling it, because they're not investing nearly as much as they were relative to their depreciation, right? So for whatever reason, but I'm saying that's the other thing we want to kind of think about when we analyze free cash flow, right? Everybody with me so far? All right, so what do we do with $3.2 billion worth of cash flow? How did that become 8.5 billion of CFI? So what happened to the non-operating cash flows? Well, they generated $3.2 billion of non-operating gains, mostly in 2018, 1.6 billion of it, over half of it, right? So they made a non-operating gain of about 3 billion. They also had basically $6.3 billion generated by decreasing non-operating assets. Okay, so that's 10 billion. And then they invested $4 billion in excess cash. Right? So basically, when you increase your excess cash, it's kind of like sending money to your savings account. So basically, they put 4 billion in savings, and of the 10 billion they generated minus the 4 billion in savings, the net is why the CFI is 8.5 billion. And from 3 billion of operating cash flow to 8.5 billion of CFI. How did they pay the 8.5 billion of CFI? Where'd this money go? Now we're on the financing funds flow side. Okay. They paid $1.2 billion in interest. So that was of the 8.5, 1.2 in interest. Negative $20 billion worth of debt. Starbucks borrowed $20 billion worth of new debt. Was that necessary? Did they need to borrow that debt?
No.
How do you know?
So their cash flows. Well, I guess this is over 5 years.
Over 5 years.
Yeah. So their cash flows, and I guess could have covered that. I guess not. No, sorry.
Actually can. If you have $3.2 billion worth of free cash flow, why do you need to borrow more debt? Because if you have free cash flow, you have essentially covered all of your reinvestment.
Maybe they want a tax shield a bit. Might as well use some leverage to shield some of their gains.
So I want you to keep that in mind as we continue on the conversation. So borrow $20 billion worth of debt. They got 8.5 billion to pay out, and then they have 20 billion more. Why? Starbucks paid dividends of about $9 billion over the 5 years. Starbucks repurchased $21.5 billion worth of stock from shareholders. Okay. 21.5 and 9 is 30 to $31 billion, rounding off. How do I pay back $31 billion to my shareholders if I only have 8.5 billion to do so?
Take out the debt and use your excess free cash flow to cover the rest.
But that's the debt. That's the 20 billion of debt.
Yeah.
The debt was to fund the stock buybacks. The debt wasn't to invest in the business. Not primarily. Does everybody see that?
Could you argue that I guess in 2020 in particular, they took on, I guess, an additional $14 billion. Could you argue that's more for expansion when you see that share repurchases was only 1.8 billion?
Well, we got 14 billion. How much do they spend on CapEx?
$9 billion.
So that's more than they needed for the CapEx. Did they do a major acquisition?
No.
20, no.
So why'd they really borrow that much debt? It's the share buyback. They're continuing to buy back stock and pay this dividend. I'm not saying it's good or bad, but I'm saying it's clear why they're borrowing the debt. Okay. Now, a lot of companies did this because we had all-time low interest rates. And why not take advantage if banks want to lend you money at 3% and use that debt to buy back your stock and reward your shareholders, right? But what I'm saying is this share repurchase, paying back $21 billion, is not sustainable, right? What is sustainable is paying out your free cash flow, right? So all the stock buyback is almost one time because it came from the banks. It didn't come from the operations being better. So I'm going to view the stock buyback a little differently as an investor, meaning I like cash. Thanks for the cash. But I'm recognizing this cash is coming from borrowed money. This cash is not coming from doing better as a business. Does everybody see that?
Could you say that just to restructure or redo your capital structure though?
Maybe that's what they're doing, but that's what they're doing. But it gets back to it, a sustainable buyback, a sustainable repurchase, dividend, payout, for lack of a better word, equals your free cash flow. Your free cash flow is your ability to pay out long term. Okay. And so if you're paying out more than your free cash flow, that's not sustainable. I'm not saying people don't do it, and maybe there's reasons you just said that they did it, but I'm just telling you that's something you need to consider from an investor standpoint. This is coming from the banks. This is not coming from customers. By the payout. We can see that here on the CFI.
Is this a way to like manufacture growth?
Manufactured earnings growth, absolutely. Buy back your stock, you get earnings growth. EPS goes up because you basically have fewer shares for the same earnings in the future, and that's EPS growth. And a lot of CEOs, comp is growing EPS. That's how their comp is going. Get the stock price higher, drive EPS. And so that's stock buybacks are one way to help do that. Right. So not saying Starbucks not alone, but a lot of companies were doing this during that period of time. Yeah, Richard.
Was the decision of doing this like spin zone by the CEO of him trying to be like, we're trying to create like long-term shareholder value by purchasing back this stock? Is that essentially why he decided to do that? Or
Sure, a lot of people will do that for PR reasons and say exactly what you just said. I'm buying back the stock because I think it's undervalued and I'm making an investment in the company. Right. And I find two flaws with that. Number one, if you really were investing in the company, open up more stores, sell more stuff. Like that's investing in the company as opposed to giving money to shareholders. That's not really investing in the company. But that being said, it's back to, okay, I generate cash and I want to reward my investors for the risk that they took. Well, did that cash that I'm rewarding my shareholders come from my business? No, it came from the bondholders. So I'm just saying that, yes, you can spin it all you want, but when you do the CFI analysis, and by the way, I'm hearing thunder and my lights just flickered. So if my power goes out, see you next week. But in any event, I'm just saying you can see past the spin with the CFI analysis. Okay, let's do another company.
And the stock's also what, 5 or the lowest been in 5 years.
Let's talk about Target during the same 5-year period. Okay, start with free cash flow for Target, 5 years, 18.9 billion positive. They generate 18.9 billion worth of free cash flow. 31 billion coming from gross cash flow from the income statement. 11.8 billion gross investment back into the balance sheet. That represented an average reinvestment rate of 38%. Of the 19.3 billion worth of free cash flow, they spent 390 million on goodwill and intangibles. Not a lot of acquisitions. Okay. Now, their capex and depreciation ratio averaged 132%. In 2021, it was 124%. What they're kind of showing here is consistent, steady growth of stores. Okay, so they're still signaling some level of expansion in sales in 20 at this point in time. Okay, what do they do with the $19 billion worth of free cash flow? That turned into 15 billion of CFI after non-operating activities. They primarily took $4 billion and increased their excess cash. So they banked $4 billion. Okay, and that left about 15 billion to pay out. How do they distribute the 15 billion? 2.7 billion went to interest. They also borrowed $2 billion worth of new debt. They paid 6.7 billion in common dividends and $9 billion worth of share repurchase. Okay, but notice the difference. What's 9 and 7?
Sure, 15 free cash
$16
flow.
billion given to shareholders. How much free cash flow did they have? $19 billion. They had 19 billion and they paid out 16 billion. This is something they can afford to do. Meaning the payout from Target for both the dividends and the share repurchase is actually coming from operations. It's not coming from the banks, right? The payout from Starbucks was coming from the banks. Does everybody see the difference? So I would actually consider Target's payout more sustainable. They can keep paying the dividends and buying the stock based on the free cash flow that they're making. Everybody see that? All right, one more company, Dollar General. What happened to Dollar General? Dollar General had negative $1.7 billion worth of free cash flow, okay, over 5 years. So they're spending more than they're making. Why? Because they had 12.9 billion of cash from the income statement. They reinvested 14.6 billion back into the balance sheet. That's 113% reinvestment rate. They spent more than they made from operations, right? And we saw this if you look back at their ROIC tree, because they were doing a lot of store expansion, right? They were trying to grow. Matter of fact, their CapEx depreciation ratio averaged 566%. And even in 2021, it was 266%. So they're clearly opening up more stores. They're signaling they still expect to grow, and they're investing very heavily in CapEx to do it. So they got negative free cash flow. And by the way, they didn't really do much in non-operating activities. They 1.7 billion in free cash flow, negative 1.5 billion of CFI. Okay. So how do they fund the negative cash flow? Well, after 476 million more had to be paid interest, they issued $11 billion worth of new debt. Not 2 billion, 11 billion, because they paid $1.6 billion in dividends and $7.8 billion in share repurchase. So what's interesting about Dollar General is while spending $14 billion in CapEx, they also gave back, call it almost 9 point something billion, almost $10 billion worth of cash to the shareholders while funding an expansion. That's what their debt was to. It was all about growth. They were the growth company over this 5-year period and signaling they still expected to grow, but they tried to reward their shareholders along the way. Probably you could argue a little prematurely, but nonetheless, a lot of companies were borrowing cheap debt at the time, and they were one of them. 3 different retailers, 3 different CFIs. Questions about any of that?
In a zero interest rate environment, Professor, would you advise companies to borrow and do the same thing?
If they could afford it, why not? As I said, if you can borrow long-term debt at like 3%, right? And think about cost of capital. If your cost of capital is 8 or 10%, you know, and shareholders are expecting 8-10% returns, why not borrow at 3 and pay off your shareholders if it doesn't affect your credit rating and if the banks are willing to let you do it? So a lot of companies did this. And that's why you saw stock buybacks at almost all-time highs. But that's the point. Why were companies borrowing debt? They weren't borrowing debt to invest in CapEx or working capital or R&D. They were literally borrowing debt to buy back stock, right? And I'm just saying, not that the shareholders didn't benefit, but that's not sustainable long-term. Because you're basically saying, as long as the banks are willing to lend me money, I can buy back the stock. But the banks don't lend me any more money, I can't buy back the stock anymore. So that's not a sustainable business. The one exception or example here was Target. Target was actually generating enough cash flow to pay back their shareholders. They're a little more conservative with their debt issues. They didn't go beyond their means. And so that is probably a sustainable buyback over time. Whereas Starbucks and Dollar General, it was more one time. This was one time for the period. But again, can't blame them for doing it. The banks are willing to let them do it. Why not?
Did the professor freeze?
Yeah. Thanks, power.
Yeah.
Oh yeah, he probably lost power.
Zoom will shut down eventually, I think.
Does anybody want to teach?
Oh, there we go.
Oh,
I would cancel classes.
Oh, classes go.
Sarah, time
Hey.
to teach.
Hey, Sarah.
Yes.
So Sarah, about that CapEx though, like, you know,
Yeah.
what the deal? Is it growing? Is it not growing?
Let's
Like,
talk about Costco. Costco's next.
Costco's next. Go get it.
Yep.
You know what I mean?
Poor Sarah. Poor Sarah.
I love Costco.
Same. All right, good night, guys. See you next week. I guess.
Have a good night.
Bye.